So, I mean, it's a fair point. There's a lot of criticism that says, hey, well, we've never been through a cycle like this with private equity as big. You're not going to make the returns. What's your take?
Well, a couple points I make. One is when you look at dry powder and private equity, actually uninvested capital as a percentage of either market cap or GDP, it's exactly what he just said. It's been the same level for 20 years. So there's a lot of talk there's too much money, but you also got to remember the economy's growing and the market cap's growing. So we're still pretty optimistic about the business. I think, in my personal view, I think 2023 is going to be a great vintage for private equity. A lot of times when banks are pulling back, that's exactly when companies need capital. And I think we would say that the operational improvements that you can provide to these companies, if you're in the right sectors with the right management teams, it's pretty dramatic. And so having spent my career starting on the public side, moving to the private side, I'm a convert, yeah.
Okay, so if last year was about, say, de-risking and worried about a recession, what's this year?
Yeah, so last year we talked about walk, don't run. We thought there were some storm clouds on the horizon. I'd say at KKR, we've got a more constructive bent. This is not a, jump into the the deep end of the pool with everything, but certainly this is a great time to be a lender, and there are a lot of public equities that are on sale. And I also think you'll see us be active where a lot of companies want to reposition their footprints. We have a long history of doing corporate carve-outs, so I would look for that to be a big theme for us.
Henry, good morning. It's Guy in London. Let's tease some of this apart a little bit. If I take a look at the public market, and I take a look at the price action, I'm going to exclude the macro data for now. It feels like we are early cycle. That seems to be the price signal that we're getting from public markets right now. A, do you agree with that? And if so, is it going to continue for the rest of this year?
Yeah, so a couple points I'd make, which is, look, there was a lot of bearish, themes out there where people were, essentially saying the world's going to end. And let's take a step back. What's happened? One is China is coming on more strongly than people thought as they changed their COVID policy. Second is, whatever you thought about Europe, they've got more natural gas supplies than we could have predicted, and we've had a warmer winter. And then last week, nobody's talking about this in the U.S., but jobless claims were near a record low, 205,000. So yep. The Fed is working aggressively. I was listening to the commentary beforehand. I mean, think about it. If you're the Fed right now, you've raised rates at a record clip, and actually financial conditions right now are easing, right? The 10-year is now at 340, and the dollar's weakening. So, our base view is they do need to do more, but they've blunted the goods economy, right? Guy, if you look at it, inflation for the goods is now down within their target of 2%. So where are we going to spend time? We should probably spend time talking about the services economy. That's where you have much more momentum and you've got much more inflation. But it's not as, we're not wildly bullish, but our thesis is keep it simple, do the things that are obvious in this market, and there's some things to do. And we've been excited about, we've gotten off to a good start this year, and I think, we invest on 5- and 7-year horizons, and you want to be in the market when things are down, and things are down.
The basis for everything is the cost of capital, which has risen quite significantly. And I'm wondering what kind of visibility you now have on what you expect that cost of capital to be going forward. And it does ultimately come back to this idea surrounding kind of where inflation's going. As you say, goods inflation coming down. We saw that in the PPI data, but services maybe not. I was listening as well to the head of the Norwegian Sovereign Wealth Fund a little earlier, the biggest sovereign wealth fund in the world. He's worried. He says it's a non-negligible risk that we see inflation re-accelerating in the latter part of this year. How confident can we be in that cost of capital right now? How confident are you in your visibility surrounding that? Okay, so let me give you the positives and the negatives. The positives is last year, as we were in the fog of war, and what we were seeing across KKR and the balance sheet was there was lots of different cost of capital data points coming in where things didn't always make sense. You might see, private equity deal at 18, but the preferred was at 16, and of course you'd want to own the preferred, or CLO liability. So there's a lot of mismatch. That fog of war is lifting, and the more that the banks actually get this risk off their books and they get back in the game, they'll help that. And so I feel good about that, and I think there's some real pockets of value, as I mentioned, particularly in credit and some of the things we're seeing in the public equities. So expect more there. On the negative, Guy, I think you raise a great point, which is China is re-accelerating potentially in 2023 at a time when inventory
inventories for commodities are really low. And most investors have actually gotten out of the commodity indexes. Very few of the big buy-side allocators own as much energy as they used to. They don't do as much in materials. So they've shrank as a percentage of the market caps. And so it doesn't take much to ignite the flame. And so those areas are going to act more early cycle. Our base view is this is a different regime. We've been doing a lot more with our balance sheet and with our LPs around real assets, particularly in infrastructure, real estate credit. And why is that? There's a higher resting heart rate for inflation. And so what I'm focused on is really three things. One is labor is going to be a more sticky input into the equation. Two is the energy transition, and not enough folks are talking about that. That's actually inflationary, not deflationary. It's the biggest CapEx spend we've seen in decades. The internet, when it came along, was disruptive, but it was deflationary. The energy transition is actually inflationary. A lot of these commodities are produced in hard-to-find areas, and a lot of them are processed in China. And then the third thing, which you guys have been reporting on, is, look, there's a lot of geopolitical tension, and so supply chains are being rerouted, and we've moved from kind of just in case to just in time. And so, General Petraeus, who works at KKR, he talks about this move from benign globalization to one of great power competition. What does that mean for markets? It means that you're going to have more resiliency of your supply chains, water, data, transportation, and all that's a little bit awkward, and it's not as efficient. So our base view, I think that's a realistic thesis, that the Fed has a hard time hitting its 2%, and that we kind of bounce around a lot more. I don't think it's the 1970s, but the great moderation that we had for the past decades, where central banks could give you a ton of visibility, that's gone.
Well, because you're talking about a more structural inflation, longer-term thesis, rather than just, say, wage and service inflation at the end of the day. We did see a chart earlier about liquidity in the market and how much it's dried up.
Yep.
Is that opening up a bit, and what does that mean for you in terms of pricing?
So I love that chart, and we track that because it tells you whether people are oversupplying or undersupplying the market. And right now they're undersupplying the market. And so you want to be an investor or provider of liquidity when that's happening. The good news, I would say, is that we need a functioning global capital markets, and I think we're starting to see that. So as the banks clear more of their books, that'll take place. You're seeing some deals where we're using the banks, but we're also using private debt as well. And so they're different alternatives. So I don't think we're going to be back to the speculative days where companies with no free cash flow are going to get crazy valuations. But for basic private equity, where you make the company better, use some leverage, you get good management teams, there's an opportunity opening up right now. And frankly, I think that companies are starting to realize that they need that capital. That's what that chart shows. And so if you can get the proper marriage there, that leads to good outcomes.
Final quick question from me, Henry. We've just seen the Bank of Japan disappointing many, not delivering the shift higher in terms of the band for yield curve control. We've got a big move on the yen on the back of that. How difficult do you think the currency story is going to be this year? How much attention did you pay to that BOJ decision?
So I'm locked in on currencies. I think this is a huge deal. Even last year, people were talking about the bond market. I mean, what most prognosticators are talking about, stocks and bonds being down. They didn't talk about the volatility in the currency market. It's historic. And what we're saying right now at KKR is the dollar's actually peaked. And so it's an amazing, when you think about last night with the BOJ, the yen got hit very hard, and then ultimately it rallied back. And there are two parts to this story, Guy. One is the U.S. is starting to slow down, and I think the Fed's not going to get to 6% on short rates. And then second is, I do think the yen's going to continue to rally, because ultimately we're leaving deflation in Japan, and they're not going to normalize the way the Fed or the ECB did, but you got a new central bank governor coming in March, and this is probably time to take stock that things are a little bit different. And so that currency reversal, that's a great signpost about our thesis.